Let me ask you something. What does a conflict in the Middle East have to do with your mortgage, stock portfolio, or even interest rates in the United States? More than most people think. Right now, global markets are watching the situation around Iran very closely. And the reason is simple. When geopolitical tensions rise in the Middle East, the first thing markets look at is oil. Oil is still the lifeblood of the global economy. And a huge portion of that oil passes through one very small but extremely important shipping route, the Strait of Hormuz. If something disrupts that flow of oil, even temporarily, prices can move very quickly. And when oil prices rise, the effects spread everywhere. Transportation gets more expensive, airlines pay more for fuel, companies face higher production costs, and consumers start paying more at the pump. And this is where the Federal Reserve comes into the story, because higher energy prices often lead to higher inflation. If inflation starts rising again, the Fed may have to keep interest rates higher for longer. But here's the tricky part. Geopolitical conflicts can also slow down economic growth. Companies become more cautious, markets become volatile, and consumers start spending less. So the Fed could be facing two opposite pressures at the same time. Higher inflation, but weaker economic growth. This is why investors are paying attention to three things right now. First, oil prices. Second, inflation data. And third, signals from the Federal Reserve. Because if energy prices spike, it could change the entire timeline for interest rate cuts. And this is something many people forget. A conflict happening thousands of kilometers away can still affect financial markets everywhere. It can influence stock markets, energy prices, currencies, and even the cost of borrowing money. If you want simple breakdowns of global finance, geopolitics, and the markets, make sure to like the video and subscribe. I post regular updates explaining what's really moving the global economy,